Quick. Our next conversation this afternoon will continue along some of the issues that have been raised during the course of the day as we look at global developments and trends in ESG integration. Whether it's climate change, a particularly difficult issue in this country given the lack of finalised government policy, or sustainable development goals, or any of the other issues that consume boards and also investors. How are those issues affecting and influencing investment decisions? And what other trends are there that are dominant in 2018? To introduce our speakers this afternoon, and if I can ask you to come up to the stage as I introduce you, YK Park is Head of Sustainability and Governance Asia Pacific at APG Asset Management. APG is an asset manager for major Dutch pension funds, and YK is based in Hong Kong. David Russell is co-head of Responsible Investment University's superannuation scheme. USS is one of the largest pension funds in the United Kingdom. USS's strategy focuses on integrating ESG into investment decisions. Anne-Marie O'Connor is Head of Responsible Investment with the New Zealand Superannuation Fund, and Anne-Marie's role is a development and oversight of the Guardian's Responsible Investment Framework. And to moderate your session, please welcome Anthony Thao, Chief Operating Officer of Lucruff Super, which is an acronym that just rolls off the tongue, not. Anthony is Vice President of AXI as well, and has been on a board member of AXI since 2013. Please welcome our panel.
Thank you very much, Ali. You're not the first to struggle with the Lucruff Super pronunciation. And thanks for that introduction. Well, we've got an excellent panel today who've travelled all the way from different corners of the globe to talk about their unique perspectives in the funds and the organisations they work for. So we're certainly looking forward to hearing from them. We're going to mix it up a little bit. We're not going to start with me leading the questions. We're going to provide the speakers with an opportunity to freestyle for 5 minutes or so. Maybe I might prompt with the odd question or two, but we certainly want to hear what's occupying their minds with global trends in their corner of the world. So we're going to start with Anne-Marie. And Anne-Marie, could you tell us what's occupying your mind as far as global trends in ESG?
Well, it's still climate change. In particular, there are other trends, but we've actually put in a lot of effort over the last couple of years, and in fact, over the last 8 years on climate change. So, just for those of you who don't know, the New Zealand Superannuation Fund, which is a sovereign wealth fund, we did a multifaceted climate change policy across our whole portfolio last year. Or a couple of years ago, and part of that was actually moving to a low carbon reference portfolio, so we've completed that to set some carbon targets or goals, to continue our engagement and continue our search for opportunities. We'd already had in place a renewable energies opportunity and strategy, but probably the thing that we've been working on most recently is something that we always knew which would be quite hard, and that's around the analyse and actually integrating climate change into valuations. So we've had some of our senior investment professionals developing a framework so that they can apply a reasonably consistent approach or try for consistency across the different investments that we're making.
And before you sort of dive into how that's going, could you give some insight into how you got buy-in for a strong climate change policy? Because there'd be many funds, thinking about what the approach should be. What sort of observations could you give the audience about what worked and maybe what didn't work?
Well, I think that having an engaged board is really important, and I think it's probably better to have a small plan and have your board, CEO and CIO all lined up behind it, rather than have a grand plan and not have that sort of level of support. The other thing we did was that we keep these issues, emerging issues, we bring them to the board early. We keep it front of mind, so cyber risk might be the new emerging issue now, or privacy. So back in 2011, we took one of our first thematic papers to our board, and out of that came our renewable energy strategy. Even at that stage, we were looking at concepts around tilting. of the portfolio. We thought it was a bit early to understand the real direction of travel. So we've brought the board along with us, and they have encouraged us. And then there were a few places that there were a few step changes, I would say. The concept of a carbon budget coming out of Carbon Tracker, for example, the Paris Agreement, where there was a convergence of business, investors, society, coming together to really ask for some consistent action and joined up action from governments, because there's the thing that creates risk is that indecision itself, and we have it when our own governments and parties fight with each other.
And was that, as a sovereign wealth fund, was that a challenge, the domestic political landscape? Did that, pose any problems for the board in dealing with the issue?
Not really, because we're a global investor and we're very, very diversified globally. But we do have some large assets in New Zealand on forestry and in farms. So in a way, they almost cancel each other out in terms of footprint to a certain extent, if you look at it in that way. But I think then the real thing is about your team buy-in. So I feel that we did our strategy twice, in a way. We went through the different elements of it and had a few people in the organisation give it their attention. And then when the board approved that, they basically said, right, well, that's everyone's strategic objective for this year, and we want it reported to the board. So in that way, I was truly amazed at how much more intellectual firepower you could actually throw at climate change once everyone had a project, whether it was looking at physical risk across all of our real assets, whether it was looking at the valuation stream, whether it was looking at footprinting, or integrating climate change into manager mandates and how to improve our engagement.
And you talk about how it's being applied across the whole portfolio. Did you want to give some examples that you think the audience would like to hear of success?
Well, I think that everyone has equity investments. Not everyone is as globally and passively diversified as us. So that took quite a bit of our time to sort of work out what would be almost the mechanics of moving to a lower carbon, more resilient reference portfolio. And we had discussions around whether we needed tracking error and all sorts of things, or whether it should be a reference portfolio or just an active decision. Now that discussion has gone to, well, what about our factor portfolios? And then it's amazing what managers can do when you actually ask them a question. So in our private markets, we've also asked for some footprinting and have brought in, specialists to help with our farms and our forests. We're starting to engage more, and David's probably got more experience in this, but engage with the private market companies and the boards there around climate change. So probably getting our managers to report on engagement, that's been really useful. But then it's over and above our alternative energy strategy. What else is there to invest in? And sometimes things are just too small for us at this stage of development, but we've developed a kind of clear filter around what we're looking for.
Okay. And I know you were in the April Investment magazine talking about the focus in labour and human rights risk, not just in emerging market supply chains, but domestic supply chains. And you spoke very strongly about the need for domestic supply chains to be the focus of companies. Can you tell us, your thoughts about that and what the New Zealand experience has been?
Well, I think you're leading here a bit with your modern slavery bill and also the experience in the UK. But I think it's come to our notice rather recently in New Zealand that we have an issue of exploitation, particularly with migrant labour, just beginning and to take hold, and thankfully business and the business associations and government have all stepped up and went, no, this is unacceptable in our own backyards when we're off engaging about supply chains overseas, which is very difficult and complex. We also have to be, definitely sort out our own backyard. Actually it was the Walk Free Foundation and the chair of Icebreaker brought together a forum and that's when I spoke in the magazine after that. And I was very impressed by Icebreaker's report, which is a premium merino brand in New Zealand, small private company. I've never seen such detailed supply chain reporting across all of the factories that their products are produced at, down to a really detailed level. So go and look at the Icebreaker report, okay? Not a listed company.
Thanks, Anne-Marie, for that overview, and I know we'll return to some of the themes you've raised as we move forward. But David, what's been occupying you at USS?
Yeah, thanks. Are we allowed to be interactive? Can I ask questions?
You may, of course.
Can you put your hands up if you've done carbon footprinting?
Okay.
Can you keep your hands up if you've done carbon footprinting in other asset classes apart from public equity? So some went down. So the TCFD is one of the, everyone knows what TCFD is. One of the requests within TCFD is we publish our total fund carbon footprint. It doesn't say publish your public equity carbon footprint. So a project that USS worked on and a report that we produced with a group of pan-European pension funds looked at carbon footprinting across a range of different asset classes. And the title of the report is, and it's on the Responsible Investor website, if carbon footprinting is the answer, what is the question? And I think we're all going along this route where we know the TCFD is asking us to do carbon footprinting. We're starting to think about how we do that. I think we've got to think out also why we're doing it. And from my personal perspective, doing it simply to fill in your TCFD report is going to be a waste of your time and your manager's time and money, because no doubt you're going to have to use service providers to do that. If you're going to use it as part of a risk assessment process, it is one tool that you can use to measure your climate change exposure within your scheme. So you'd need other tools to look at things like scenario analysis. But carbon footprinting is a tool that you can use to identify where you might have hotspots or key risk areas within your portfolios. And I say portfolios because, as I said, you've got to not just look at your public equity portfolio. And this group of pension funds published this report. We highlighted some of the issues there are with carbon footprinting. One being you're potentially using 2-year-old data, because the CSR report is based on the carbon data reported within that is based on data which is usually a year old, and it's taken a while to get to you. So it's old data. If there is any data, or if there are any data, you might have to use estimated data because there's no data being published by the company concerned. So you're already looking at stuff that's old and estimated, and that's the easy bit because that's public equities. When you start looking at your private markets assets, for direct assets, we have infrastructure and a few other direct assets, it's really easy because they're ours and we can ask the management to give us the data. If you start looking at private equity, the GPs are simply, I'm being very black and white here, the GPs are largely not collecting the data at all. So if you start asking for it, they simply can't provide it. The underlying portfolio companies might be collecting some energy data, they might be looking at carbon footprint, but private companies don't usually publish this stuff. So if you're looking to try to footprint your private equity portfolio, you're going to face challenges. If you're looking at your sovereign debt portfolio, again, you have to think about how we're going to do that. And there are lots of methodology. And we all have relatively large exposure to sovereign debt because it's part of for us, it's part of how we measure our liabilities and balance our risk. So how are you going to measure the exposure to your sovereign risk portfolio, which is one of the big chunks? Real estate might seem simple. We own buildings, direct property, so we know the energy we're using and we're paying for within those buildings, but we don't know the energy that's being paid for by the tenants of the buildings. So we might have a really £100 million building, and we're spending £15,000 a year on electricity because the tenants are picking up all the rest. So how do you add that into what, in the end, could be a total carbon footprint for your fund? You're adding lots of different chunks up that come up with an answer that basically means nothing. But that's what the TCFD is asking for. So I would caution against going along that route as a total fund number because it doesn't mean anything. Use the data to look at risks within your portfolios rather than try to do something for the whole scheme.
And so how are you filling the gaps? Are you relying on your internal team or what approach?
So we're working with one of the, there are so few service providers in this space, we're working with one of the longest standing ones of them to try to come up with processes to do that. So for private equity, to be honest, we're not even bothering to ask the managers because we know we're not going to get very far. And we have very big relationships with a lot of very big GPs, and we will struggle to get the data. So what we're doing is we're starting to collect revenue data, and with revenue data, we have a look through to the underlying portfolio companies, and we can start to estimate what they are. Basically, if it's a retail company and it made X amount of money, the service provider can say, well, it looks a bit like that company, therefore it's going to have a footprint of roughly this. So at least we can begin to estimate where the carbon footprint might be an issue for us within, for example, a private equity portfolio.
And what's your assessment of the UK companies that you monitor around their CSR, ESG reporting? Do you think that's helping drive voting decisions, or what they're providing you is not adequate?
I think the UK is reasonably good, as is the Australian market reasonably good. If you start looking at some of the European countries and the US and then start moving into emerging markets, it starts becoming a lot thinner in terms of the quality, if there is any, of CSR reporting. So one of the projects that we've been running for a few years at USS is trying to encourage companies to do more reporting. And we use a voting process. So we're all used to voting shareholder resolutions, but outside America, there are a handful of shareholder resolutions that we get on E and S issues over a year. So what we've started to do is to review what companies are disclosing in terms of CSR data, carbon data, health and safety data, how they're managing supply chains, and we're using a service provider to do that. And if they're not providing adequate levels of disclosure, in the first year we'll write and tell them we think they need to improve their disclosure. In the second year, we will abstain on report and accounts or the reappointment of the chair of the CSR committee. And in the third year, we will vote against. So we have an escalation process to reinforce to company they need to be providing us with appropriate data and at the right time, because we think that CSR data should be included in the remuneration of management. So getting an annual report in April and a CSR report in October, you kind of think, well, they're not linking their CSR data with their annual report data and therefore their REM data. So we're pushing for CSR reports to be done at roughly the same time as annual reports. And just to finish off, that sounds really good. The problem is it's a very blunt tool. We are looking very specifically, are they saying anything? And we're rolling it out to countries where it's relatively easy. So Australia is relatively easy. Most companies will say something. America is a bit thinner. UK, it's not so, it's good as well. We're doing Japan this year, so we're expecting more on the environmental side, less on the social side, because that's part of how they report their stuff. But it's not looking at the quality. It's a simple, are they saying something about something? So at least it's a start, but we think we'll have a long way to go. Once we've gone through around the world and got the whole voting system up, we'll then start focusing on, okay, what's the quality of this disclosure?
Thanks, David. And I've got a couple of questions I want to come back to, but we might move to you, YK. And welcome to Australia. I understand this is your first visit.
Really?
And I can't resist the temptation. Every Australian always asks the new visitor, what is it like? Do you love it?
No. The question was, you must come to Melbourne as well.
Yes, Melbourne is a fine city.
That was, yeah.
So, yeah, welcome. And I know you've also been very active in climate change engagement throughout Asia. And we're very interested in your perspectives, particularly about setting carbon budgets and your experience. Could you share some of that, and then we want to get on to another area of interest of yours?
Yeah, so what we do is carbon footprinting, something similar to what David's company USS does, but conceptually, this is how we do. So each and every PMs will then get, so we calculate first carbon. So that, I mean, all the problems that David mentioned is our problem as well, data problem. And then, but we get along with it, we move on. So that each and every PMs, portfolio managers, and then the team as a collective, as a team, they will get a budget. And then in 3 years' time from now, 2 years' time from now, by 2020, compared to 2015, they need to reduce 25%. So that each and every PMs will get budget. There is a little bit of flexibility between, within the team, but they need to, as a team, they need to cut by 25%. That's regardless, active team, passive team, quant, hedge fund, doesn't matter. So I think that's in principle. Whether we get there, by 2020, I don't know. We are working on it quite hard. So that if you think about, let's say, a PM investing in Australia, dead. I think, good luck to you. So I think that's so that some PMs will then cover, let's say, Japan, for example. Dead again, because Japan's power market, utility market is like coal-based, basically. Korea did. So there are a lot of crying PMs are there, but that's where we are going. And our clients, by the way, APG, we are right under pension clients, so that they are clients, but at the same time they are our parent company. So that's we are, and then we manage 80% internally, 20% give out, so that we are kind of hybrid in between asset owner and asset managers, so that we have both problems, being an asset owner and asset manager. So that I think that's where we are going. So far, okay, lots of crying. SDI, that's another area that we spend a lot of time. SDI, United Nations SDG goal, sustainable development goals. And then based on that, we came up with, definitions. So the SDI, sustainable development investments. So that we came up with definition and the taxonomics, so that we do have that definition.
Glad you said that.
Yeah, we do have it. So and it's open. So if you can actually go to our website, there's a definition. If you do have a problem, please write to me, because I am supposed to collect all the other views. So what we did is not perfect, but we calculated how much we have, 51 billion euro. So we calculated whether it is perfect or not perfect. We try to move on. And our clients set a very hard target. That's by 2020, APG need to increase up to 58 billion euro. So we are about 7 billion euro short. But we are going there. We are spending a lot of time doing that one.
With the Sustainable Development Goals, there are so many. How do you determine which ones you think you could best, find investment opportunities in? Is that a real problem or an issue that you face? Indeed.
So that I think what we started about 2 years ago. At 2 years ago, I still remember the first meeting. The first meeting was very cold, because all PMs, portfolio managers, and then even us, ESG, ESG specialists, we say that no, this is not possible. Peace? No, we can't do that. But I think as time goes by, actually we can do little, this one okay-ish. So that at the moment, out of 17, 4 goals, we can't do much about peace, especially peace, inequality. Okay, government, you have to have some jobs, so that, okay, government, you do it. But the other 13 goals, I think we have one or two elements at least. So that, and then what we did was, based on the sectors, utility, energy, so there are pharmaceutical, for example, real estate. So that I think we found something. So that now RPMs are much more open than actually 2 years ago. 2 years ago, I mean, it was like this many people, and then very cold, all doing like this. But now it's okay.
Good. Look, AXI, you'd be aware, has been a strong supporter of one share, one vote capital structure. And in Hong Kong, the exchange is undergoing consultation about unequal voting power with listings. Could you give us your observations about where that debate is at, and what are your thoughts about it?
Hong Kong, weighted voting rights. I think basically institutional investors basically fail to keep it, one share, one vote principle. So I think that introduction of, in Hong Kong at least, introduction of weighted voting rights, it's happening, I think. And then I think it is going to happen within this year. So I think we basically lost. I strongly opposed to that idea, and together with many other institutional investors, but failed. So I think that I should blame US, very relaxed listing rules, allowing this. And then what happened was that Singapore, then both Singapore and Hong Kong, they were thinking about, okay, we can't lose IPOs all the time, especially Chinese companies listing. And then Singapore went ahead, and then Hong Kong basically, we can do it. So Singapore did it, and we can do it. So that there's indeed, competition to the, bottom to the race, racing to the bottom is happening. And now I know the Malaysian government is actually, so Singapore and Hong Kong does it, then why not us? If you talk to Korean Korean government, and then they are talking about this as well. So they indeed, I am very worried that this whole thing is actually, someone actually opened a warmer can that's opened already. And then how many worms will come out, I don't know. So
YK, that might be a good opportunity to open up that discussion to the wider panel. As investors, how can we better coordinate ourselves to ensure that our voices are continued to be heard on this important matter? David, would you?
I think we have to, just as an aside, I think the French also have unequal voting rights for longer term shareholders, which kind of skews the market to government held holdings in big French companies. I think we can individually write in response to consultations, and as was mentioned earlier, there's a consultation by one of the service providers going around at the moment. But I think the louder our voice is through the organisations we're part of, whether it's AXI or ACGA, I can see Jamie at the back, particularly in an Asian context, because it's China. Chinese companies are driving this at the moment. It was basically Alibaba not going to Hong Kong and going to the US instead. That was what driving this. So I think we need to have that investor voice, both individually and through the organisations that represent us, and have people on the ground who can feed into that.
Anne-Marie?
Well, I suppose I was looking at it in another way as well, because we have both private and public listed companies, and sometimes we're a very small investor in there alongside other LPs and GPs in technology companies perhaps coming to the US market. And it's very hard to be the lone voice, right? And when practice becomes standard practice, you can have dual listings so long as you've got, a phase-out period, for example. It can be quite difficult. So I think that for asset owners who are on both sides, you could engage the actual private equity firms in the discussion about actually not bringing dual listings to the market. Now, it might not help with the Chinese companies because of the ownership or the race to the bottom, but we can at least raise our voice with our other investments as well, I think.
And David, this is a novel area in the UK that I was fascinated by and wanted to quiz you on. And I think you have warned this is not your strong area of expertise, but can you outline the laws in the UK around political donations? Because many in the room wouldn't know that in the UK, companies must seek shareholder approval before making political donations. And I think that would be a very interesting set of AGMs if that was the case in Australia. So could you tell us about your observations there? And
so it's part of the Company Act that at each AGM, if a company is planning to make political donations in the following year, they have to seek approval from shareholders, and there's usually a kind of de minimis number that kicks in. One of the issues with the regulation is political donations is quite broad, so it can be charitable donations, it can be attending a political event, it could be providing money to an NGO, because NGOs could be considered political actors, and it can be giving money to the Labour Party or the Conservative Party or the
Does
Republicans
anyone give money to UKIP?
but actually, some do, but they tend to be private companies. So it enables us to give voice to concerns we might have about basically companies giving away our money to mainly political parties. And I think it's been quite useful because I think companies now tend to self-censor. They used to make more political donations than they currently do because if it's seen as egregious, they will be voted against. And last year in our portfolio, we saw 28 companies, with political donations. And we do look at everything when we vote, and most of those donations would have been to NGOs, would have been something that was fairly innocuous, but 2 of them were to proper political donations, and they were BAT and Diageo, and you have to think of the sectors they are in, and it might not have been political donations in the UK, it may be in other countries where the whole system revolves around political donations, so it enables us to say no. The problem is, not enough people say no.
Question for YK and Anne-Marie. We know about the Modern Slavery Act in the UK, and we've seen it in existence for a couple of years. Do you think that would be effective in your markets? Is that something that you'd encourage? And what's your observations about the UK experience? And David, please chip in if at the end of the comments.
Pretty early days for discussion in New Zealand, but we're a very small market, and I think it's such a significant issue, particularly if it starts to be in your own backyard, that I think companies will begin to address it anyway. But it was really very useful, though, to review the UK statements on this, and I think that disclosure really helps other companies in those sectors globally understand what the risks are and how to manage them. There is already ESG reporting requirements under the code, New Zealand Corporate Governance Code, Comply or Explain. So we'll definitely be raising that as an issue with those sectors and companies where it is. And it's not just in the listed markets, it's very much in the private markets as well. So I think there's already tools there. But I'll be watching with interest the impact it has here.
Your views, YK?
Same. But then I am based in Hong Kong. I am looking after Asian companies. Basically, we are in the primary school status. A state compared to, let's say, discussion here is actually quite, university level discussion. And then in Asia, when I actually talk to the company and then listening to what they do, is basically it's a primary school kind of idea. So climate change, for example, human rights, slavery, labor. They all say that, or the CEO, talking to CEO or board members, and then zero idea. So that I was talking to Mr. Wu at some company. And then, asking about, this labor practice and climate change issues, and then they go, oh, okay, I'm CEO, I'm not responsible for that. And then he was saying, okay. And then he was saying, oh, by the way, IR head, we don't have this climate change problem, don't we? This is a steel company. So that's the situation we face. So that I actually wanted, there's a reason I'm here. The reason I'm here is that, let's say, Australian companies have you guys were quite harsh on yourself this morning, whole morning. But I think that Australia still, it's by far, provide good standard for the rest of the Asia. So I think that, and a lot of Australian listed companies actually come around and then meet with Asia-based investors, especially in Hong Kong and Singapore. That gives a lot of education for investment community in Asia. I think that's a fantastic thing. What's not less being done is that Australian asset owners, you guys need to come around to Asia and then meet with your Asian holdings. So they meet with Mr. Wu and then say that climate change is your problem. What are you talking about? Or board members. So that message I want to actually give you. Come out. Please educate your investing company's management.
Thank you, YK. We'll take that positive endorsement to cheer us up for the afternoon. That's been excellent. We feel a lot better. But I think you touched on there about the trend maybe for stronger collaboration internationally, whether it's Australian investors moving into Asia and having more direct engagement. But I'd like to ask the panel before we open up to questions from the floor. We've seen some fantastic initiatives, international collaboration initiatives. And if you were to be able to influence one big trend or one big idea where we could collaborate together internationally, what would it be? And happy to start with maybe you, Anne-Marie.
Yeah, you didn't tell me you were going to ask that
No, I didn't. I
question.
thought I'd left one.
This is a sneaky one.
It's not all scripted.
What to choose? Well, I think climate change, everyone's very engaged and there's a lot of information and ability to collaborate if you wish. So I think it is around this concept of sustainable development. I know Larry Fink's letters kind of hit a few desks with this whole discussion on companies licensed to operate, and now we have obviously in the finance sector's license to operate, very much centre stage. But I do think that more global issues like sustainable development is what's focusing my attention anyway at the moment.
David?
So yeah, the Larry Fink thing and the role that we as asset owners play in not just the fiduciary responsibility we have to pay pensions, which is obviously the primary responsibility, but I think that broader discussion needs to be had about where we fit into society as a whole and what's our role within the SDGs and such like things. But actually I think what we should be doing better is assessing how we as investors across the globe are using our external managers and the due diligence we put into seeing how well they're doing ESG. But beyond that, the monitoring and holding them to account where actually they're not delivering what we think they should be delivering. They said this in their due diligence, but actually the reality is that they're not doing what they said they were going to do. And I think it's a real failure in it's not just public markets, it's private markets as well, and in fact, probably in particular private markets. We should be better at getting together and talking to the managers that we share to make sure they're doing what we want them to do. And it is not easy, it's an international problem, and they divide and conquer. You're the only person asking for this, honest. So I think we should be working together internationally to try to actually get the fund managers to do what we want them to do.
In Asia, so in Asia, I think that if I look at why Singapore and Hong Kong institutional investors basically fail to keep one share, one vote principle, is there are two reasons. One is asset owners were not necessarily strong in those two markets. The other one is there is no strong AXI type of, ACGA has been very active and then but ACGA was the only kind of strong, brave organization to actually stood up at the time. So I think that why don't we actually, ACGA and ACGA's members, including all of us, work together, and then when we go to let's say China, come with us, and when we go to Japan and Korea, come with us. So work together from today.
Excellent.
There we go.
Thank you. So I think it's a good opportunity to throw it to the floor to ask questions of our international panel. And please, could you state your name and organisation that you're from? And I think just there at the back, we've got our first question.
Good afternoon, Adam Kirkman from AMP Capital. YK, nice to see you in Sydney, entertaining as always. I've got a question about your crying PMs and the 25% reduction objective that they've got, I think you said by 2020.
Yeah.
Are the PMs unconstrained in terms of how they might set about meeting that objective, or is there some other ground rules the business has thought about around things like diversification, strategic asset allocation as part of that?
Yeah, so I think that we are still struggling. I mean, I need to admit that one. So then this is the first year, basically, we are trying to adjust our portfolio. So that one way we try to do it is basically simply cut down the number of shares that we invest in. So that in the past, the total number of shares were about 5,000 shares around the world. And now we cut down to, let's say, 4,000, still a lot. And then I think that we focus on good companies, really responsible companies that we invest in, so that through a lot of due diligence, and then a lot of let's say this footprint calculation, we pick up good companies that we invest in. I think that's one way to do it. I think that's where we are at the moment. Maybe next year I can talk about, okay, these are what the issues, so that we had to come up with this, but not at the moment. So I think this year is an initial year. We are actually thinking about just that one first and see what happens.
Just over here, I think we had a question.
There's one there. There's one with a mic.
Oh, you'll be next. Sorry, didn't see you there. Just here at the front. Yeah.
Hi, YK. This is Daniela from HESTA. You mentioned that APG has a target of 58 billion invested in the SDI. Is there like an investment case, or what's the investment case for investing in the SDGs, or is it mainly a values driven, or is it expected that companies that are aligned with the SDGs outperform in the long term?
Yeah, so the SDG, so that we have a SDG, and then based on the definition, we have SDIs. And then for example, different asset classes, for example, fixed income, we have green bonds, and social bond and sustainability bonds. So that I think that market is growing substantially, especially in China. If you don't know China today, you don't know half of the this whole green markets what's happening. So I think go to China. I think that's my simple recommendation. So green bond, and then those bonds is big portion, and then the other one is real estate investment. So that we rate those companies and investment, and from that perspective, and then best performing companies that we rate them as SDIs. And for public equities, each and every industry and sectors we invest in, we have a definition, and then based on the very tough definition, we actually calculate it. Renewable energy investments and pharmaceutical investment that is providing affordable, good quality medicines to people, that sort of thing. So that it took almost a year for each and every PMs to come up with that kind of idea. So the PMs basically, they were all ESG analysts as well.
So I think we had a question just here. Yes.
Hi, Xinting from K-Super. Nice to see you here, YK, again. So hopefully we'll next time see you in Melbourne. But my question is actually around the debate you sent out about the calling Australian asset owners to come out and educate the investee companies on ESG issues and climate change issues. So I wondered about, in terms of the channels out there, I think you mentioned about Australian asset owners can collaborate with APG engagement, but also is there any other formal channels to support the activities in this
Yeah,
space?
so basically, I was talking about ACGA, Asia Corporate Governance Association, where APG is really active participants. Every year, there are 2 or 3 investor delegation to each and every market, not every market, so the major markets. So let's say in China, maybe in India, or in Korea, Japan, that's happening. So it would be great, actually, and then actually members actually come and visit, and then part of the delegation, and I think you guys will learn quite a lot. And a lot of, I think, have you noticed that all of a sudden your companies or website visitors increase, number increase? It's because, sometimes I mention that, okay, this company in Australia is a model case, or this company in Australia is a very good reporting case you might want to. So that I have been basically recommending, Asian companies to actually look at and visit your website. So that, it's time actually have a face-to-face meeting. So this represents Australian market, and then, you guys can actually teach.
We might have time for one very quick question and a quick answer from whoever on the
We were
panel's
told this
got it.
morning that simple questions are the important ones. It's a simple question for David. Despite or because of being out there on ESG and many other important issues, USS has grown immeasurably. How has USS grown so big? As a member of USS, it's always been a mystery to me.
The simple answer is we have fantastic investment returns. But the more complex answer is we're still a growing cash positive fund. We have an equity type bias, so public equities and private equities, a growth bias at the moment, because we're cash positive and will be for quite a while. I mean, we're a big fund and we've got a lot of money coming in and we're making good returns. It's quite simple. And the market's gone up hugely in the last few years, so we've ridden the wave like everyone else has.
Well, thank you very much, all of you, for a very informative discussion about global ESG trends. And I know everyone here would like to give you a warm thank you.